Hello, I am Keith Dreyer, Vice President of Practice Services of Henry Schein. We're fortunate to have this webinar today from the senior leaders of Stifel. Stifel is a global wealth management firm with roots back to 1890. They have more than 8,000 team members and more than 2,200 financial advisors. Today's webinar is Investment Strategy, an update on the economy and impact to dentistry. We're fortunate to have Michael O'Keefe, Chief Investment Officer, and Sneha Jose, Director of Behavioral Finance. I'm going to start reading with this disclaimer, and then we will get right into our webinar. This webinar and materials that you will view were prepared for general information purposes only by the presenter and are not intended to be a substitute for professional advice, not purported to be comprehensive. Henry Schein does not guarantee the accuracy or reliability of the information provided herein and does not undertake any obligations to update or revise any statements contained herein or correct inaccuracies, whether as a result of new information, future events, or otherwise. Any reliance on any such information is solely and exclusively at your own risk. Dental and medical professionals must make their own business decisions and may wish to seek professional advice before acting with regard to the subjects mentioned herein. Nothing contained herein should be treated as legal, business, accounting, international, insurance, tax, financial, or professional advice. Henry Schein shall not be held responsible for any consequences or of reliance upon any opinion or statement contained herein or any omission. The opinions expressed in these materials are not necessarily the opinions of the presenter, Henry Schein, or any of their affiliates, directors, officers, or employees. For the avoidance of doubt, the foregoing also applies to Stifel's market projections, which are not endorsed by Henry Schein. It is now my pleasure to turn this over to Michael O'Keefe to talk to us today. Welcome, Michael, and thank you.
Well, thanks so much. And we're really pleased to be with you all today. A little later, I'll turn the floor over to my colleague, Sneha Jose, who's head of behavioral finance. So we're going to talk a little bit about the market environment and all that's going on with coronavirus and COVID-19, but then also talk about it from the perspective of the economy, the markets, and some behavioral considerations you might want to make. So, we always start these presentations these days with this slide and sort of graphic. You can see here at the bottom, this concept of flattening the curve. Now, if we go back a couple months ago, maybe 3 months ago, when we first designed this chart, a bunch of us sat around the table and we're trying to figure out how do we want to represent what's going on here in terms of the environment. And we're reading, like everyone else, what the heck was going on. And at the end of the day, what we realized was that that we wanted to essentially capture the idea of slowing the spread. Now, we all today, I think, all know what that means. The spirit of it is simply to say, look, we want to slow the spread of the virus, keep the impact below the capacity of the healthcare system, spread it out over time, in part to buy time for medical research to advance. And we're going to talk about a couple of these things as we go. But again, I think in today's environment, we all have a pretty good feel for the concept of flattening the curve. Now, as it relates to the virus itself, here on page 4, basically we can see both at the US level what's going on, and then we just picked 3 states to sort of illustrate. But let me kind of walk you through the way this graph is developed. And it's, I think, very interesting. First and foremost is the blue line. And what you're seeing is, and these are daily sort of tests being given, you can see that the volume of tests is accelerating. And they've been growing and growing and growing over the last few months, and that's going to continue. We all, I think, understand it's critically important to test. But then you can see at the bottom, really right next to 0, is this little green squiggly line. Believe it or not, that's the total number of confirmed infections, again, daily. And they're almost indiscernible in terms of them coming off the bottom. But then I think an important line is the gray line that starts off, looks like a little bell curve, and then it kind of comes down, stays flat, and then interestingly in the fall potentially goes back up. That's basically statistically modeled estimates of the total infections out there. And so the spirit of this is, we know because of testing, we're not capturing all the infections yet, but you can also see, for example, with New York, where, and this is where Sneha and I are based, essentially we know probably from commuting and sort of the transit systems that the cases really hit hard and quick. And you can see that estimated curve go way up to almost 100,000 a day, believe it or not, and then kind of quickly come back down. Places like California and Texas that shut down much earlier basically have been relatively flat. And of course, what everybody's interested in is this going to kick up at some point, especially in the fall. And some of the models assume that things go way back to normal and the virus may kick back up. Now, as it relates to reopening, this next page kind of just gives the first part of the government's framing on reopening. The spirit of it is to say, look, and this was from the CDC and the administration, we expect to see monitoring of basically 14-day windows. And if you see improvement, both in terms of the number of cases, the percent testing positive, and even symptoms, and the hospitals stay under control, you can move to the next phase of reopening. And the idea was create some kind of monitoring system at the state and local level, watch, and as things improve over an interval of 2 weeks, then you can move to the next stage. And here on page 6 was those original guidelines, the way they thought about it. They thought about it happening in 3 phases. Phase 1 you can think of as very minor steps. So maybe gyms open, but schools and bars stays closed. People still work from home. You still avoid large group meetings, certainly protect the vulnerable. So even after that first 2-week interval improvement, you go to phase 1, very small opening. Phase 2, then after another 2 weeks of improvement, things open up a little bit. People start to go back to work, schools open, bars, gyms remain open, some travel starts to resume. Then if you get to another 2-week improvement, then they sort of guide it, then you can really start to reopen. And I know what we realize, of course, is that around the country, both at the state level and sometimes at the local level, the governments have basically taken the spirit of these guidelines and implemented their own. So many different places have many more than 3 phases. For example, here in New Jersey, we just started to reopen, and I don't even know the count, but it's a lot more than 3 in terms of the reopening. Again, when we look at what's going on around the country, the good news is that basically every state is either in its entirety or at least regionally within its states starting to reopen. Now, obviously, as it relates to the impact of what happened, essentially, we all were asked to stay home. It's obviously impacting your business. We're going to get to that in a minute. And here you can see a chart that kind of shows how quickly the total population of the U.S. basically shut down and we're under restrictions. We went through a period of time and now they've rolled back off. And in fact, if we look at page 9 here, which is more data around, it's interesting these days, you basically can get mobility data. And I think a lot of this comes from Google, where people are tracking the phones. And you can see what people are doing, where they're going, et cetera. And this is sort of a roll-up of that. And some of the interesting observations, you can see just a slight increase in sort of workplaces and things like transit. We're starting to make our way back. Grocery and pharmacies kind of back to relatively normal levels. But what's super interesting is parks. So people wanting to get out and walk around and get some fresh air are operating well above normal compared to pre-virus conditions. And again, I think we all see this day to day in our lives. Now, I mentioned a moment ago the idea of sort of waiting for the medical benefits, medical innovation. And here on page 10 is a super quick snapshot of where we are right now. The spirit of this is we've got, at last count, 163 companies pursuing vaccines. Many of them now are in testing, a few towards the later stages of testing. That's obviously great. The idea that we can get a vaccine even within a year to a year and a half would really be a record. And then the second dimension of this is, at last count, 239 companies pursuing therapeutics, the idea of treatments. And treatments, interestingly, that are showing at least a little bit of benefit. There was one that relates to, I think, anti-inflammatory for people on respirators and so forth, that they talked about improving the morbidity by a factor of 33%. So not 100%, but still saving 1 out of 3 lives is terrific. So again, we're monitoring this because we believe medical advances are going to have a significant impact on the market. Now, turning to kind of what's happened, obviously the economy got hit hard as we shut down businesses. Markets got hit hard, and both sort of parts of the federal system that's here to help us in these situations kind of kicked into gear. So the Fed controls monetary policy, and then we have sort of the administration and Congress controlling fiscal policy. And in both efforts, really historic levels of support. In the case of the Fed, essentially brought rates down to near zero, number one. Number two, essentially stepped in and participated in markets, used their balance sheets to buy securities, especially in places where liquidity was sort of at risk. And then the third is, as lender of last resort, basically creating a bunch of loan facilities. On the fiscal side, we've had two bills passed, one for 2.3 trillion, the other for 484 billion. And the spirit of those basically, number one, get money back into the hands of people, especially those that have been impacted. Number two, give a raise to unemployment. Number three, essentially help businesses, especially to motivate them to keep people employed. And there are a couple other bills that are sort of drifting around, one from the House, another from the administration, around infrastructure. And we'll see how that unfolds. That's going to be a little bit more of a political debate and discussion before those get implemented. Now, I mentioned the Fed. Page 12 just gives us a quick sort of rundown of interest rates. And I draw your attention to the upper left, that sort of blue bar that looks like a step. That's basically the Fed funds rate. That's where the Fed's controlling short-term rates. And you can see that they increased rates for a while into 2019. They brought them down a little bit in the mid to later part of 2019. And then this year, basically, boom, right down to zero. Their sort of lowest sort of non-negative level. On the right, you can see sort of the shape of the yield curve. We always wanted to have a positive slope, meaning 30s are higher than 10s or higher than 2s. And in the current environment, that's the case. But of course, across all three of those, and really the whole yield curve, rates are low. And that's sort of by design. The Fed wants to get rates and keep rates low so that borrowing is less expensive. And then obviously, another part of that is sort of beyond treasuries, how companies are borrowing. And so the bottom of this page basically shows spreads. It's the amount that companies have to pay the lender, the investor in their corporate bonds, to basically issue the debt, or in the secondary market for us to buy the debt. And you can see there was a little spike kind of corresponding to the equity market volatility we'll look at, but they've come back down towards normal levels. So speaking of equity volatility, if we look at page 13, we can see the story of 2020 against the backdrop of 2019. So 2019 was volatile. It seemed like such drama at the time, geopolitical risks like US-China trade or Brexit, or even Fed policy. Those were the three factors that drove volatility last year. But we ended the year really with historically very positive returns. So if you look at that S&P 500 return of 31.5%, that's very unusual, and that's a very positive number. And we sort of innocently came into 2020 thinking, hey, everything's going to stay good. It's going to be, a good year. And the markets were all pretty pumped. And you can see, for example, the S&P 500 and the Russell 2000, sort of the large and small cap stocks here in the US, had a positive return until really the third week of February, where we realized as a country, as a world, and certainly as investors, oh gosh, this virus is a real serious problem. It's going to cause some trouble in terms of things shutting down. And the markets basically rolled over for over a month between February 19th and March 23rd. And I think importantly, in sort of industry speak, we ended our almost 11-year bull market. So we ended up in a quote unquote bear market, down 20% or more. And the good news is, since that March 23rd low, we're basically climbing our way back. And what we're looking for is recovery. We're going to talk about that. Page 14 shows how volatile this outbreak has been relative to the kind of patterns we've seen in the past. And there really are two reasons driving this. The first is that markets, because of that extended bull market, were pretty richly valued. So you can think of it as a little bit of room to move down. But then I think more importantly, because this virus is so contagious and could, without control and sort of awareness, sort of overtake the healthcare system, that really spooked people. Obviously, we ultimately shut down the economy, and that really kind of spooked the market. The market since then, as I alluded to, has really been trading higher, and is doing so really on optimism around the reopening. Page 15 is just a reminder that these bull and bear markets happen through history. This one's a little unusual because it's an external shock, this virus, but you can see both in terms of the length of the bull markets and the magnitude of the move back down. This is right now a relatively normal thing, except for the down move, the move down, and the recovery is happening a lot faster than normal. And again, that's, I think, because of the man-made nature of the shutdown and the reopening. Now, page 16 gives us another lesson about investing. And here's all the 15% declines in the S&P 500 going back all the way to the late 1920s. And the takeaway here is when we look to the next 12 months after that decline, essentially, how has the market done? And you can see, of course, every time it's recovered, every time you see a green bar, it's recovered beyond the losses, meaning it's gotten its way all the way back to the previous record and then climbed further. And then for those that are gray, you can see the length of time it took to get back to even. And so the big open question is there at the bottom, or we're just a few months into the recovery. And so we're going to obviously update this when we get to that 12-month mark. But I would say there's a reasonably good chance that we'll get back to even from this particular move down. Now, switching gears just a little bit to the sort of the things we're monitoring. When this virus hit, not that we stopped looking at what we normally look at, but we said we have to start looking through different lenses. And so we put together a dashboard we call the coronavirus dashboard. It's 2 pages. Here's the first page. And I'll just draw a couple things to your attention. The idea is we're watching for damage and we're watching for recovery. So you can see, for example, on this page, a couple or a few GDP forecasts. There's Bloomberg consensus for the world, expecting on a consensus basis to be down 3.7% for 2020. You can see the IMF's forecast for the world is down 3%. And then the Bloomberg consensus for the US, which obviously we're super focused on, is down 5.7% for the year. And we all know that we're in a recession, and we'll get into some of the magnitude of that, but this is all sort of predicated on recovery in the second half. I'll mention another thing at the bottom of this page is the New York Fed Weekly Economic Index. This is a brand new index from the New York Fed. And the idea is taking sort of coincident real-time data. I think it's 10 factors in there. Think of it as things like spending on gasoline, job issues, and all that. And they're basically sort of normalizing it to how GDP has done from a year ago. So as of the print of this chart, it essentially was forecasting a year over year through now, a decline of 10%. That number's actually popped up in the latest reading down to, I think it's up to like negative 8.3 or something like that. But the bottom line is we all know the economy has been impacted. Anyway, on the second page, page 18, this is really around confidence and other survey data. So as an example, the manufacturing indexes, sort of the Empire State, Dallas, and Philly, those are 3 regional manufacturing surveys trying to take a pulse on how things are going. And all of those numbers turn quite negative. But I think it's very interesting to see that New York area, New York Empire State Manufacturing Index basically popped back up to almost neutral, which is a huge move up from where it had been. The other thing I'd mention is the consumer. We're watching consumer confidence very carefully because ultimately the consumer makes up about 2/3 of the economy. And it's super important that we as consumers kind of re-engage. So whether it's going back to restaurants or spending in whatever ways we might, that idea of sort of having comfort and confidence to do that is critically important. So monitoring consumer confidence is very high on our list. Now, in terms of employment, employment's got hit hard. We just published on this recently, but the spirit of this is to say we saw, I think, a 14.7 was the last print on the unemployment rate, where there's some speculation it could go to 20. But actually ended up seeing some recovery. So the latest print is 13.3%. And so that's something obviously that we're watching very carefully. And one of the reasons, if you look at page 20, is here's not all, but a number of industries that have been impacted by the shutdown. Things that are obvious: food services, membership associations, physicians, et cetera. And you can see Office of Dentists, they're on number 12. Basically, we're seeing the number of job losses in thousands, all of this adding up for this particular cut, March through May for these 25 industries, of 14.8 million job losses, and then correspondingly the lost income. And so 476 billion at the bottom of the page, that's a significant amount. And then that's why the government stepped in and it was looking to really try to support the individual. Here on page 21, to take a step back and look at businesses, is a bankruptcy index. And we see here in 2020, that's kicking up a little bit. We see it in the news, et cetera, but a little bit of a tick down. And then correspondingly, companies preserving cash, sometimes a little stressed for cash, are cutting or suspending dividends and buybacks, not quite to the level that occurred in the financial crisis, but getting there. And it's still early in the year, so we'll see. So when we look at this, here again are a bunch of industries that have been impacted. So consumer spending, which I mentioned, employment, which we've discussed, and then earnings. So here's basically the magnitude of earnings for each of these industries and sort of how they contribute to the market, in this case, the S&P 500. And that's really important. In fact, page 24 kind of gives us a quarterly look. And this chart on the upper right of this page, basically the green bars were the innocence, representative of the innocence of the early, all of us as an industry sitting around and forecasting earnings. And we thought basically we'd see growth quarter to quarter, each quarter looking year over year. So the spirit of it is we're going to see continued growth in earnings. That was the view. And then once the virus hit and we realized we're really shut down, then the blue bars are where people see it today. So the first quarter is actually in at roughly around a 15% year over year decline. There's an expectation of a huge hit in the second quarter, and then recovery back towards where we started as we make our way through the end of 20 and into 21. Now getting to the dental industry, here's a chart that may be familiar to you. This goes back to the financial crisis and kind of where things were projected to go. I'm a bit of a quant minded person. You can see that sort of almost like linear line pre-financial crisis. And once you hit kind of 2008, there's a forecast, a projected spending pattern that would continue to be linear. And then what actually happened, of course, with the financial crisis and the recession that hit was that things declined. And so one of the things we're watching is, okay, how does this help us inform what might happen to all of you kind of looking forward? Obviously, as it relates to the spending patterns of dental practices, and you all know this better than we do, it appears that the first half of the year is a little bit more active than the second half. So the fact that this shutdown has occurred in the first half is particularly painful in terms of that pattern of dental spending. And in fact, if we look at this next page, basically this gives us sort of a picture of how things are going with this reopening. I know for myself, I just scheduled my delayed cleaning. But you can see here back in the week of April 6th, to go back that far, 84.8, so 85% of surveyed had less than 5% of patient volume activity. And so basically, as you know, the industry was shut down. The good news is as we make our way into June, sort of you're seeing things kind of come back to normal. And again, what we're monitoring higher level is, okay, how quickly is this going to occur? We have always talked about May and June as being pivotal months, and they've so far sort of delivered. And again, we'll get into that a little more in just a second. As it relates to the sort of the economy, here's a picture that just shows you the magnitude of what's going on and what's expected. And these are all annualized numbers. So you can see the first quarter actually came in at roughly down 5% on an annualized basis, but everyone's expecting a massive economic decline in the second quarter, really coinciding with the full shutdown. And then what everyone's expecting at different levels and based on different opinions is a significant recovery in the second half. And right now that's what the market's trading on. And I would say that the view is that we think, and investors think, that we'll be able to get through the reopening without having to close businesses if things can be carefully and well managed in the market, and forecasts are sort of reflecting that. As it relates to the shape of the recovery, here are sort of three graphics that talk about how people think about it. There's the L shape, which is not a good one, where you see decline and then stagnation. There's a U shape where you have decline, maybe things pause for a while, and then they eventually come back. And then there's V shape, which happens quickly in both directions. Right now, we think we're kind of in between a U and a V. It's been a little bit of a slow start, but what we expect to see with increased confidence and reopenings is things to start to accelerate. A big worry if there's another shutdown is a W. We have some recovery, we shut back down, we go back down, but we don't think that's going to happen at this point anyway. We started the year worried about a bunch of things, focused on a bunch of things. One of them was the election. So we just have a chart in here to sort of show you a snapshot. This happens to be betting odds, but I think other measures, polls, for example, are showing this, that Biden has an edge right now. And obviously, I think that at the heart of it from here on out is how well does the recovery do, and how do people think about it from the perspective of leadership in terms of the president and former vice president who they might want to vote for. So obviously, we think it's a little bit of a toss-up, but we'll see as we approach November where that goes. Now, the last thing I'm going to speak about, and then I'll turn it over to Sneha, is our outlook. We tend to think in terms of scenarios. And if you looked at the beginning of the year, the virus wouldn't have been mentioned, but now obviously everything's based on the virus. So our base case at this point, when we look forward, is that we're in recession, but recovery will ensue in the second half. We think things are going well and they'll continue to go well, and that everybody's sort of fighting to get back towards normal. Correspondingly, the economy will kick back in, we'll see more jobs created, and we'll see the markets maintain at these levels and maybe go a little higher. But we've sort of painted two other scenarios. To go to the bottom of the page, a bear case scenario is basically that we're wrong about the reopening and that things have to be softened or shut down again. Market won't like that if that happens. Market will trade down if that happens. But then correspondingly, the bull case basically looks to the reopening going more smoothly, especially if supported by medical innovation. So imagine they find a vaccine that's effective. Even if it's going to take a number of months to get it produced, the market will trade to that sort of recovery and the idea that we've got an answer. And I'd say the same thing about highly effective therapeutics. People are just looking for a way for all of us to be able to handle this virus and the corresponding disease and be able to get through it. So medical innovation will be key. So with that, I'm going to turn it over to my colleague Sneha, and we'll talk a little bit about behavioral considerations. Sneha?
Yes, thank you, Michael. Thank you for your comments. So the current environment, as Michael has kind of talked about in all of these slides, is, it's basically something that we've not seen. But, while slowly things are getting back to normal, this feeling of uncertainty, stress and anxiety is only natural for us to have. And with markets, just like us, markets don't like uncertainty, right? We've seen huge swings in both directions, positive and negative, and it's almost been like a roller coaster ride. Think about it. Since January, the beginning of the year, investors were euphoric, and then they became complacent, and then fear and panic and anxiety hit, and now we're slowly coming back to normal. So it's been a range of emotions. And in all of this, I think for us, it's very important to stress on the fact that, to understand the human element, the human aspect, and that's our session. And behavioral finance does exactly all of this. It combines psychology with finance to understand all of these interactions between markets, emotions, and individuals. And I think what's most important is it explains it's that human beings don't always make rational investing decisions. And decision making is largely influenced by our emotions. Some of the examples that I have on page 32, if you see, is, why do investors behave the way they do? Why do investors buy high and sell low? Why do investors stay away from a deeply discounted investment, but then go, for a sale? Like, let's say if Macy's has a sale, you go all out, but you kind of stay away from markets that are going in discounted fashion. And then the other one that, we've heard a lot of investors kind of feel, and we've heard a lot of press cover, is essentially FOMO, the fear of missing out. Essentially, if there was a stock or a market you wanted to be invested in for a long time, you're basically seeing that, this investor feels like, oh, I missed out. Oh, I missed out. And that is the whole concept of fear of missing out. So, a lot of this, I think the most important thing is behavioral finance is important because it's about understanding biases. And if you look at page 33, while there are a number of different investor biases, we decided to list a few of them. The first being loss aversion. Now, most investors have a natural aversion to losing money, and studies suggest that the impact is much stronger. It basically hurts twice as much to lose versus gaining. And investors subject to this bias could probably panic sell during sharp market declines. Now, I'll give you an example. It's a very famous experiment. Let's say we have two options. Option one for investors is to have $450 for sure. Option two is to have a 50% chance of gaining $1,000 and a 50% chance of gaining nothing. Let's think about it. What would naturally people do? Most often, investors would choose option one, which is the $450 for sure. And that really speaks to the whole concept of loss aversion. The second one I wanted to point out on this page is herd mentality. The herd behavior is usually when individuals tend to behave like the larger group they're associated with. Now, probably they wouldn't make these decisions on their own, but just because of the influence, peer pressure, or influence of just listening or following a market guru or any other concept, basically would make them probably make some decisions that may or may not be right for their investment. And the third one, and the last one on the page, is recency bias. Again, a very common bias, very relevant with what we're experiencing today, is the fact that we live in the present. With all of this information that is on our fingertips and on our phones and watches, we're just living in the present, and we tend to forget the events that happened in the past. But we try to, we're just naturally kind of making decisions in the present. And especially when markets are volatile, investors are vulnerable to making some short-term decision making that could hurt their long-run success. And with that, I wanted to go to page 34. Because in page 34, Michael actually shared this page, and we wanted to show it to you again. But this time, we wanted to show it to you from a behavioral lens. Remember, everything that's in yellow and pointing towards the left are market decline periods of greater than 15%. Now think about it from a loss aversion perspective. Obviously, investors were hurt during this period. It was difficult to navigate through this period. But again, think about it from a behavioral perspective. If we were able to identify those investors who were very uncomfortable, help them kind of navigate that short term, help them stick to their plan, and not have to have had made decisions during that period, which could have hurt them, the recovery would have happened subsequently in 12 months. And that is, again, a very important example. The other one I wanted to share is if you focus on the last two or the most recent events, I think let's take the September 2018 and December 2018 period. This is the fourth quarter of 2018. And if you may recall, at that time, investors were panicking. There were a number of different factors: recession, tensions with China. All of this led to a very fast, swift market decline in the fourth quarter. And if I recall correctly, it was the worst December, followed by the best January. A lot of investors left the market in December, only then did not come back, and hence missed out on that rally. So to put another example, again, from a market perspective with behavioral finance, it's page 35. And if you look at this page 35, again, it's a chart we share very often. And what you're looking at is essentially two lines. The blue line is the investor who invested in the S&P 500 and just stayed in the market. The yellow line is the investor that basically missed out the top 15 trading days. And essentially, if you look at it, it's basically time spent in the market versus timing the market. It's almost impossible to pick a top or pick a bottom, but the idea is a lot of the returns happen on specific days, and trying to come in and out of the market sometimes is not rewarding as much as just staying the course. So again, another example we thought was worth sharing. So what do we do about all of this? Acknowledging biases, emotions, and essentially embracing the whole concept of behavioral finance. If you look at page 36, what we're doing here at Stifel is we are focusing on trying to understand our clients and our investors and their behaviors and their preferences. So what we've developed over the years is a proprietary financial ID, which essentially is the financial ID as in financial identity. And it's nothing but a simple questionnaire, right? And it just basically measures a number of dimensions using all of the great stuff behavioral finance offers from an academic perspective. If you look at that chart or that image in the bottom half of the page, to the left, you see traditional risk tolerance. Now, most firms, so even us, all of us, basically as a first step measure what's called as traditional risk tolerance. This is the first step. What are your income requirements? What are your liquidity needs? What is the time horizon? A number of these factors are kind of taken into account. But on the right-hand side, what the financial ID does is it's measuring across a lot of these dimensions, 6 dimensions to be specific. 3 are focused on attitudes towards risk, and 3 are focused on decision-making preferences. Who you are, how you feel, what kind of decisions you like to make, where do you feel comfortable. All of this is factored. Now, we don't have time to go through all of these dimensions, but I did want to point out specifically to composure. And on page 37, you will see an example. So if you look, basically what we're trying to measure is how an investor feels, how they react. Do they get stressed? Do they get anxious in short-term market swings? That essentially is the definition of composure. The lower the score, i.e. that dark line, the lower the score, basically what it means is that the investor is feeling stressed or anxious during that period. Now imagine a situation, this investor is a pretty balanced investor, but imagine a situation where the risk attitude is very high, but the composure is really, really low. Now this investor wants to take a lot of risk, but has this very, very low composure, i.e. will tend to react and maybe want to make some decisions that might hurt them in the short term. That is the kind of investor we want to pay a lot more attention. We want to help them because there are a number of different ways, strategies that we can use to essentially smooth out the return patterns. Smoothing means essentially that, there are a number of different ways to get from point A to point B. We can either deploy extra cash in the portfolio or use a lot more defensive strategies, especially for investors that have lower composure. That's 37. That's one of the dimensions. 38 on page 38, if we go, basically what we are doing is we're showing you a quick snapshot of the questionnaire. It's available. It's 36 questions. It takes about 10 minutes to complete. And as a next step, what we do is essentially try to analyze where you land on each of these dimensions and how can we actually fine tune your portfolio. So we don't have to shake and make a huge number of changes, but what we can do is we can help you fine tune your investment portfolio by learning a little bit more about your behavioral tendencies. So again, on 39, on page 39 is information. So if you are interested in taking the questionnaire and learning more about all of the work we do at Stifel, feel free to schedule this complimentary consultation session and to click on this link. With that, I'll wrap up my section of the comments, but I will turn it back to Michael to kind of share some final thoughts and comments.
Sneha, thanks so much. I think at this point, what we're going to do is turn to some questions. And so Sneha and I are happy to answer any questions that you might have.
Sure, great. Thanks for the extremely informative presentation. It really gives you great perspective, and obviously history is quite the teacher. So Michael, I'll start with you. What was your guidance to clients early on in the virus, if you could back up in time a little bit?
Sure. Well, interesting, and I'll go back to just before the virus, because as the virus hit and the market reacted, our guidance shifted a little bit. If we will go back to the end of 2019, recall that I said that the equity market was up very strongly. And something that's less on people's mind in that environment is thinking about risk. So believe it or not, before we even knew anything about the virus, Sneha and I and other colleagues were quite saying to clients, look, we've had a great run in the equity market. We're almost at 11 years for the bull market. This is the time to look at your composure. Would you be able to handle a strong move down? Not knowing what was coming. So basically, if you think about that first month or so of 2020, that was really a drumbeat that we have, was make sure you're comfortable with your level of risk. And when markets are up, that's a great time to sort of rebalance. Then when the market reacted to the sort of the awareness of the virus, and we had a very strong move down, that's exactly the time when we think it's important for long-term investors to stay the course. So our guidance was sort of captured, and we do a weekly note, which everybody can get on this website here. But basically, that weekly note said, "Stay the course, ... really." So as bad and as dramatic as it felt, our guidance was to not sort of capitulate to the sense of risk. And of course, as we mentioned, once it bottomed out, the markets have recovered quite well. So we feel good about having provided that guidance.
Thank you. Sneha, I'll go with you. Can you please give an example of how a client's identity has helped them and their financial advisor set their investment strategy?
Yes, absolutely. In fact, this is something I was mentioning in the presentation as well. This was an actual client situation that we had. It was a long-standing client for this team, and the client actually took the financial ID questionnaire after many years of being invested and having the relationship with the advisor team, and found out that he was actually low composure and higher on risk. So we did actually implement a bunch of strategies, as I was mentioning, which is focusing on the fine-tuning element and essentially trying to buy some emotional comfort in the portfolio. And that was via, we kind of had a little bit more buffer cushion or for cash. It could be used as dry powder potentially, which is essentially going back and investing in the market should the time be appropriate for that portfolio. But the idea was that identifying that lower composure was key, because that kind of helped us make a lot better decisions with the investor for that portfolio.
Great, thank you. Michael, let's talk about guidance. How has your guidance changed as the situation has unfolded? Because obviously we saw that exponential ramp happen.
Sure. So I think that's actually a super interesting question, because one of the things we often do is we're sort of studying the environment. And one thing we know about investing in general is that you want to be highly diversified, because wherever you invest, there's always the risk of loss and sometimes permanent loss. And one of the things that we realized about the current environment is that the risk of permanent loss, and again, something we wrote about, has increased quite a lot. So think of it as businesses closing to sort of help with slow the spread, but not being able to handle the delay or the pause in their earnings and their revenue, and basically go. And so the concept of permanent loss has been more in focus for us. And that's caused us to kind of evolve our guidance in two ways. The first is that from a top-down perspective, we're ever more guiding clients to invest in higher quality investments. So whether it's the equity market, looking for companies that can weather through, or on the fixed income side, being mindful of this sort of credit quality of the issuer. That's been a theme that's been with us. And then the second is, while sometimes it's a good time to just buy the market, you'll hear it about passive investing or ETFs, which is still a reasonable thing to do. But we think for those that are considering it, and the financial ID actually helps you gauge whether this is something you'd be interested in, the idea of active management, hiring a professional who's going to worry about that concept of permanent loss, and not only avoid the traps as best as possible, but also, frankly, in this kind of environment, there's lots of good opportunities out there because of the volatility. So that idea, quality investments, but then consider active management.
Great, thanks. I'll take this one for Sneha. What are some ways to avoid getting hurt due to emotionally driven decisions? We're in an uncertain time now. By using the Stifel identity and behavioral finance is part of an investment process.
Sure. I think the best way to answer this question is if you take some of the most recent events that have happened We've seen a lot of volatility. And essentially, as an investor, if you recall those months of February and March, where you felt really uncomfortable and you felt stressed and panicky about your portfolio, I think it's a time to go back and revisit your portfolio. Doesn't mean you have to make a lot of shifts and changes, but it's worth going back and revisiting because you're addressing that discomfort, that feeling of, stress and anxiety, because that is important. And I think the financial ID helps in a variety of different ways. And as Michael was mentioning, that well-diversified portfolio, having good investment discipline, kind of sticking to the plan is very helpful. But you have to have the right plan to begin with, which actually is built for you. It's not just, a portfolio out of a suite of portfolios that somebody thinks might just work for you just because you have to get invested. It's a little bit more of a customized approach. So that's where we feel that the financial ID, the behavioral element, the customization element really then makes a strong fit and helps you stay invested and helps you stick to your investment plan.
Great. So you talked about obviously more on the individual basis. And Michael, I'll talk to you about the grander scale. This whole pandemic, were you taken by surprise of this?
Yeah, yes and no. So one of the things that's interesting about investing is by its nature, there's just loads of uncertainty out there, both in terms of the environment and the markets. And one of the things that we do as a team is publish what we call our geopolitical dashboard. So the spirit of that is to say, we don't know exactly what big risk might unfold, but we're going to sort of identify some that may cause trouble and then monitor the environment and watch it. And so in all candor, we didn't have on that list something as specific as the coronavirus pandemic. And so, we're sort of ready for the unexpected. What I would say that's really challenging for not only ourselves, but those in our industry is what I've framed as we've moved in some ways from the concept of uncertainty to unknown. So the sort of the scale of not really being sure exactly, number one, what's going on and how the data is moving. Usually you're monitoring things, you're watching incremental changes, but the wholesale job losses, the wholesale decline in the economy is something that really no one's prepared to be able to analyze. And so there's been, as an industry, all of us sort of retooling and building data sets and information specific to the virus. And of course, today you can go on weather.com and see how things are going in your neighborhood almost. So the data finally is well present. But anyway, long story short, we're ready for the unknown, but we weren't necessarily listing this as one of them.
Great. I'll do one more question with each of you. So Sneha, can you just talk a little bit about short-term and long-term thinking? Obviously, people are focused on short-term. You look online today, you read the newspaper today at the headlines, the trends, but focusing on long-term, as you mentioned, before about those 15 trading days in the whole cycle of things, how do you stay focused long-term and mix it up the right way?
Very good question. And I think it's exactly a lot of things we tried to cover earlier in the presentation, which is it's difficult. It's hard because of those biases we mentioned, right? The recency bias, especially because we're fixated in the short term. But I think every time to take a step back and to look at what the long-term plan is designed for, I think it's very helpful because that's when if you have frequent discussions with your advisor and kind of, reset the plan if it needs to be, but kind of essentially factor in a lot of the elements that are happening, that is actually very helpful to stay the course for the long run, because it is challenging. And just being human, we tend to react. But then again, being mindful, being aware of biases, being educated about a lot of these events, looking at history. Obviously, there's no guarantee about past performance. But that said, we have seen time and time again, no matter how you cut the data, no matter how far back you go, I think the bottom line is, at least markets, equity markets for the most part are resilient and do come back. And that's, I think, most important for us to keep in mind. And it's also the whole concept of emotional comfort. Like, we have to have that emotional comfort, right? Like, for us, if you're looking at the current environment, for me to go back to the dentist to get a cleanup, am I going to feel emotionally comfortable? Well, I'm going to see what all they're doing in terms of all the practices they are following. That's going to give me emotional comfort. And you take that same example and you put it into your finances and your investment portfolio. Like, what all factors are going to give you emotional comfort to either stay in the market or venture into the market if you haven't. So it's a number of different factors. It's the car mechanic example, right? You're going to go to the expert to get advice. That's how I would think about it.
Great, thank you. And Michael, let's wrap up with you. There was life. You were monitoring a lot of things besides the coronavirus, and even with and without, there are certain catalysts for a possible upside and downside in the market. Can you just talk about that, please?
Yeah, sure. I mean, I think of it this way, and it's back to Sneha's comment that the equity market in general is quite resilient. It's almost like our system at work, right? People are going to deploy money into a business, sometimes through the public markets, because they believe the business is going to flourish and do well. And so the idea of the equity market having a long-term positive return is sort of foundational to the way our system works. And also, frankly, it's a key input to our financial planning, right? So if we're working with clients, we have these long-term expected returns. But to your point, there's all kinds of volatility and triggers for volatility. So there's no question at all that we monitor for those triggers. And we're trying to, as much as anything, educate ourselves, our financial advisors, our clients on how to think about those things. So right now in this environment, we have things like the U.S.-China trade tensions remaining in place. We have things like a little bit of stress in China with Hong Kong. We have things like the uncertainty of North Korea's behavior. There's a lot of focus in another areas on Europe and how is Europe working as a union, basically. How's Brexit going? There are all these things that in normal times are really kind of key considerations. So they remain on our radar. And I think the spirit of it is to say, look, we do monitor for anything that we think foundationally changes the long-term expected return of equities, but we're not seeing anything. So what this is really about is having a long-term plan, investing in a level that you're comfortable with from a risk exposure and a composure perspective. And then if you're there and you've got it dialed just right, stay the course through that volatility.
Right. And the only thing I would add is you don't have to go it alone out there. This has really been informative. A big Henry Schein thank you to the two of you, Michael O'Keefe and Sneha Jones. Thank you for your time and your resources, and found this very beneficial. Thank you.
Great.
You're very welcome.
Thank you. Thank you so much.